Hi, it's Kalindu from Study with Kalindu. From today, I'm going to start a new video series that is going to be focusing on financial ratios. I'm going to do some working examples also for you to really understand what do financial ratios mean and why is that they are very important for different companies, different corporates. So, a ratio is a representation of a fraction or a number in a certain manner. Any number we can represent as a fraction, as a decimal, as a ratio, and as a percentage. So, financial ratios is a method by which we show or we demonstrate a relationship with respect to a company's performance using simple ratios. So, any financial ratio can be presented as a percentage as well. So why do we have financial ratios? What is the objective of having financial ratios? The answer to that question is simple. Ratios are easy to understand. Percentages, anyone can understand. It tells us a story. And when you calculate different ratios over a same period of time, for example, if you calculate 5 different ratios for a company for the year 2023, that will tell you 5 different things about 5 different aspects of the company, right? And if you calculate one single ratio for 5 consecutive years of that company, say for example 2019, 20, 21, 22 and 23, 5 years, you calculate only one ratio across those 5 years, that will tell you that one aspect of performance, how has it varied over the last 5 years. So this is the main reason why we have ratios. Ratios tell us stories, what has happened in a company with respect to different aspects in a given year, as well as what has happened in companies with respect to one specific attribute or characteristic or area of performance over a period of time. We say this horizontal and vertical analysis in a way, and in another way we call this time series analysis, because we are looking at the company for a specific period of time. So it's very interesting to have these ratios calculated. Shareholders, investors, angel investors, venture capitalists, they look at your financial statements if you are a company and they calculate these ratios. I mean, they don't personally calculate, but they have people for them to calculate these ratios. So these are performance ratios that will portray a story as to how your company is doing. So then, needless to say that these ratios are very significant or comprehensive. How do they become comprehensive? Because we have multiple different ratios for multiple different aspects of a company. So mainly or broadly speaking, we can have 5 different types of financial ratios for a company. First type, profitability ratios. That talks about the relationship between your profits and your revenue. How much of your revenue is translated to your profits. Secondly, leverage ratios. Leverage means the gearing of the company. What is the balance between debt and equity, right? So leverage ratios tell about or talk about what's the balance between debt and equity. Is the company highly geared? Is the company not geared enough? These are the things that leverage ratios are looking at. It gives an important signal why high leverage is not great. Low leverage means you are not exploiting your opportunities enough. Then we have efficiency ratios. I mean, how efficient your company's performance. Are you very good with collecting money from your receivables? Are you practical enough in paying the people you owe money? Are you very efficient in converting your inventory back to cash? So these are the things that efficiency ratios look at. Then you have market value ratios. Market value ratios look at, well, Are your shareholders getting enough benefits out of the company's operations? And as a result, is your performance in the company accurately reflected in the valuation of your company? So all these earnings per share, price to earnings, price to book value, price to sales, different aspects, different ratios. So these are market value ratios. Then on top of all that, you can have profits, you can have leverage, you can have great market value, you can have great efficiency. But if you are not liquid enough, you are going to run out of cash. You will have to file for bankruptcy. So liquidity ratios are of paramount importance. So you will be having liquidity ratios as well. So current ratio, quick asset ratio, cash ratio, things like that. How liquid are you as a company? These are the things that will be looked at in liquidity ratios. So altogether, 5 types of ratios: profitability, leverage, efficiency, market value, and liquidity. I mean, not necessarily in this order, but broadly speaking, these are the 5 different types of ratios that you will be calculating as a company. So today I wanted to do a bit of calculations and just to give you a flavor about these profitability ratios, because these are very easy and very much of value companies, and I mean these are the most fundamental level things that you are going to discuss when you are looking at financial ratios. So I am going to present you a few calculations, and together you can do these calculations with me and exceed your understanding on these ratios. Let's say you have a revenue. Let's say company A has a revenue of $100 and cost of sale $55. Other operation, other ops expenses $20. Then financial expenses $10. And then tax paid $12. So this information is available with respect to the company A. Let's look at this information once again. You have company A with a revenue of $100, cost of sales $55, other operating expenses, operational expenses $20, financial expenses $10, tax paid $12. Now using this information, we are supposed to calculate 3 things. 1. Gross margin ratio. 2. EBIT margin ratio. Number 3. Net margin ratio. So these are the 3 things that you have to calculate. Let's calculate the first one. Gross margin ratio. What is the gross margin ratio? The formula is fairly simple. GM ratio, gross margin ratio, equals GP, gross profit, divided by revenue. And how do you calculate the gross profit? Once again, very easy. Gross profit is revenue minus cost of sales, cost, divided by revenue. And your revenue was what? 100. Your cost of sale was 55 divided by 100. So 45 divided by 100. This is your ratio as a percentage. Gross margin ratio is 45%. So Your gross profit margin is 45%, which is a very good gross margin. Now, one other thing to learn, your revenue minus cost of sales. We in finance give it a special name. Revenue minus cost of sales, we call it the contribution. So, GP ratio equals what? Contribution divided by revenue. Gross profit margin ratio or GM ratio is equal to contribution by revenue. Okay, that's about the first one. What's the second one? EBIT margin ratio. So for you to calculate the EBIT margin ratio, you need to first calculate the EBIT. EBIT is earnings before interest and tax. Earnings before interest and tax. This is EBIT. So, how do we calculate earnings before interest and tax? Very simple. The contribution minus other ops expenses. So what was your contribution? Your contribution was 45. We calculated in part 1 minus other operational expenses. What was that? Let's go back. Other operational expenses is 20. Right? So 45 minus 20 is your EBIT. That is $25. So EBIT margin ratio is 25 divided by 100. We can represent this as a percentage, 25%. So EBIT margin of the company is 25%. And then lastly, we were supposed to calculate the net margin ratio. Net margin ratio is number 3. Net margin ratio is net profit divided by revenue. So what is your net profit? EBIT minus finance costs minus tax divided by revenue. So I want to make a side note here. EBIT minus finance cost gives you EBIT minus finance cost. This gives you EBT, earnings before tax. Now this EBT minus tax gives you net profit. This is why I wrote the net profit as earnings before interest and tax minus finance cost minus tax. So our EBIT was 25, finance cost was what? 10 and tax paid was 12. So finance cost is 10 minus tax paid was 12. This divided by 100 is your net margin ratio. So 25 minus 22 divided by 100, you have a net margin of 3%. So we have answered all 3 questions. And was this difficult? Not really. You just needed to know how each ratio is calculated. So answer to our question, what is your gross margin ratio? This was 45%. EBIT margin ratio was 25%. Net margin ratio was 3%. Are these the only profitability ratios we calculate as a company? Not really. there are plenty of other measures that you can look into. EBIT margin ratio we calculated. Similarly, you can look at EBITDA margin ratio. You can look at in the airline industry, for example, you calculate a measurement called EBITDA with an R. You can look at EBITDA margin ratio. Likewise, I mean, there are many other profitability margin ratios you can calculate, especially when you are a manufacturer, when you are a production company. You can calculate different profitability ratios with respect to your fixed costs, allocating fixed costs and not allocating fixed costs, with and without. You can calculate many other profitability ratios. You can calculate profitability ratios with respect to your products, your regions of operations. So it's a very broad topic, but this is the basis. If you know to derive each profit item, calculating the margin is fairly simple. You just divide it by your revenue. So I think this was helpful as a flavor or as a starting point of financial ratio analysis. I believe this was helpful. So my objective for the next video is to actually take you through some financial statements of few companies and really show you this is how you look into multiple years and draft a story of companies' performances. Stay tuned with my channel. If you haven't subscribed my channel already, please do subscribe. Press the bell icon to receive notifications. I am active on Facebook, Instagram and TikTok. At Study with Kalindu is my handle or username. You can reach out to my accounts and follow me over those platforms. I do conduct one-to-one tutoring sessions. You can reach out to me on my website. My email is info@studywithkalindu.com. To look into my tutoring career and myself, you can just reach my website, visit my website www.studywithkalindu.com. Happy studying to you all. Let's meet on another day. Thank you.